Welcome back to Street Smart. I'm here at the Clinton Global Initiative, and my guest here is Jim Chanos of Kynikos Associates. Jim, great to have you here.
Thanks, Carol.
There's a lot of macro issues, and I know you're not a macro guy, but I'm just curious, when you look at some of what's going on in Europe at this point and their difficulty in solving the situation, what it means to you, what it means, if at all, in terms of how you invest.
Well, I mean, one of the things, obviously, we were concerned about more recently was the European short-selling bans.
Right.
So they went right down the road that the rest of the world did in 2008. And we pointed out at the time that following the September 2008 short-selling bans in Europe, in the U.S., and the U.K., the funding crisis got worse in the banks in October and November of 2008. And sure enough, when they did the short-selling bans here in Europe, the funding crisis got worse.
You're saying it would be better if the short selling was allowed?
They keep forgetting that the largest short sellers and purchasers of credit default swaps in financial institutions in times like these are other financial institutions, basically hedging their bets of their counterparties. And if they can't do that, they begin to pull. And that's what we're seeing. And again, the regulators don't understand how the markets are interrelated in these things, and they just figure if they stop short selling, it'll stop the problem. Short selling in these shares were the symptom. It's not the disease.
If you could be, would you be aggressively shorting the European banks at this point?
We were short the European banks prior to the ban. We can't
do
anything now, obviously.
But if you could have continued.
Well, I think probably yes. I mean, in that there seems to be a continued reliance on this so-called kicking the can down the road, where we're going to solve the debt crisis in Europe by adding more debt. And as I said a few months ago, I mean, the can is kicking back. And I think this is where we are. Markets are sick of these solutions. They know the accounting is no good. Look at the European stress tests a year ago on the Irish banks. They said they needed a few billion euros. They ended up needing 30 billion euros.
Right.
I mean, so these tests are a joke. The accounting is a joke, and the markets are beginning to just say, no more.
What do you make, though, of some news of, I think, the Italian credit downgrade today? And actually, we caught up with the CEO of Fiat, who waited on the downgrade. I want to get your thoughts, but let's just hear what he had to say. Oh, we don't have it. Okay. Well, he did weigh in on it, and I think talked more about kind of the macro conditions. I mean, as we continue to see more chinks in the armor, in terms of Europe, do we see that the situation can be fixed anytime soon, or is it just something that's going to continue to linger for the next 6 months, the next 12 months? Well,
compared to the U.S., I mean, roughly 25% of our GDP is government spending right now, which a lot of people think is too high. In Europe, the number is 45 to 50%. So this is really so built into the structure of the European economic system that starting down this austerity path that the Germans and others really, feel is necessary, is going to, as Greece has found out and Ireland has found out, is not going to increase growth. It's going to decrease growth. And so we're in this weird trap of the fact that no one seems to have ever taken macroeconomics 101 in terms of trying to cut their way to prosperity.
The IMF came out and they lowered the growth estimates for the United States and really for the world today, even brought down China. I'm just curious, do you foresee another recession at this point? Is that a good opportunity for you to even go out and take more short positions?
Well, I mean, as you prefaced, I'm not a macro guy, so I mean, my opinion on this is not so good. I mean, and as you also know, I think that while everyone's focused in Europe, my focus is a little further east, and I think that's the interesting wild card going into 2012. The fact that we think the Chinese growth engine is beginning to sputter.
And I mean, I mean, when do we see the bubble burst? I know it's property that you really are concerned about in China. We've talked about it a lot with you. I mean, when does it really come undone, and what are the implications? Is it something akin to the crisis that we went through with our property bubble?
Well, I think that it's happening. I think it is coming undone, and I think that right now the property stocks are sort of leading on the way down, followed by the financial institutions in China. But we have a proprietary sales data survey we take every week, and the data came in last night, and in September, which is one of the seasonally strong months in China, condo sales in Tier 1, Tier 2, and Tier 3 cities were down 50 to 60% versus a year ago. So this is happening. I mean, it's not something that's going to happen. It's happening as we sit here.
Right. And you and I actually talked before we all started about how nobody really looks at the Chinese government balance sheet in terms of the amount of debt that they have. Talk to us a little bit about that.
Well, the Chinese government balance sheet directly does not have a lot of debt. It's de minimis. But the fact of the matter is the state-owned enterprises and the local governments and all the other ancillary borrowing vehicles have lots of debt. And it's growing at a very, very fast rate. And the assumption is the state stands behind all this debt. Well, if we look at it on that basis, and Fitch and others have done so too, we see that debt in China, implicitly backed by the Chinese government, probably has gone from somewhere about 100% of GDP to about 200% of GDP recently. And those are numbers that are staggering. Those are European kind of numbers, if not worse.
So what happens? I mean, how do you see it playing out? You talk a lot about a Chinese property bubble.
Right.
If the debt load becomes unmanageable, I mean, what happens to China? I think we all think of it as being so strong financially and fiscally, and yet numbers show a different story.
Well, I just think that's going to be the surprise going into the end of this year and into 2012, that it's not so strong.
End of this year.
Yeah, I mean, I think, as I said, the property market is hitting the wall right now, and things are decelerating. The CEO of Komatsu said just last week that he's having trouble getting paid for his excavator sales in China. So developers are being squeezed. They're turning to the black market for lending, this sort of shadow banking system, which is now growing by leaps and bounds, like everything in China, sort of starts at nothing and suddenly is huge within a year or two. And regulators over there are really trying to get their hands around the problem. Meantime, the local governments have every incentive to just keep the game going. So they're just continuing with these projects, continuing to borrow, as the central government tries to rein them in.
Now, you've been short Chinese banks, and you continue that?
We're short Chinese banks, the property developers, commodity companies that sell into China. Anything related to property there is still a short.
Anything you like in China?
Yeah, we're long the Macau casinos. It's our long corruption, short property play.
All right, interesting. And you've had that for a while, though.
We have. I mean, again, we feel that there's American management, there's American accounting, there's subsidiaries of American companies, and they're growing at a faster rate even than the property developers.
Hey, you know, one thing we've been talking about the IMF lowering the growth estimates for the world at this point. They did lower it for China as well, but it's still about 9.5%. Right. But is it a trend that you think is going to continue? We're going to continue to see those growth rates brought in on China, and it will indicate some of the worries that you've been pointing out?
Well, look at it this way. I mean, a lot of people are assuming now that half of all new loans in China are going to go bad. In fact, the Chinese government even said that last year relating to the local governments. If we assume that China is going to grow total credit this year between 30 and 40% of GDP, and half of that debt is going to go bad.
How can it be good?
That's 15 to 20%, and say the recoveries on that are 50%. That means that's 7.5 to 10%, Carol. That means that China, on an after write-off basis, may not be growing at all. It may be just simply having to write off some of this stuff down in the future. So its 9% growth may really be zero. You
know, in terms of the deleveraging of the world, we've seen it kind of go through corporate America a while ago. Right. It's going through individual households here in the U.S. The government's doing it. We're seeing it in Europe. So it comes around to China then.
I think, again, the story that people are missing here is that China, the world's growth engine, remember, it accounts for roughly 1% of world GDP growth. It's about 10% of the world economy growing at 10% a year. That's going to be a bigger drag than people think going forward.
You know, your research team goes over to China, and I know the last time we talked with you, I think it was in spring, you talked about how things were, when they went over there, things were much worse than you guys, and you guys became even more bearish. You've had folks over there recently as well.
That was the last trip. Late spring, but we'll be back over there.
But again, the research that you continue to get from China just says,
and you don't have to be there. Again, I mean,
I know we've talked with you about people who criticize that you don't go over there.
As I've said, you know, no amount of visas in your passport can substitute for a lack of judgment. And just, I think sometimes you miss the forest for the trees when you're that close.
Do you feel like, in terms of general coverage, I mean, I think it's interesting when you talk about the debt of some of the government-owned enterprises. It's not a story that's being told. No,
just still generally the world believes that China is an engine of growth and will continue no matter what sort of happens in the West. And I think
it's not immune.
It's not immune. And number two, they focus on its export businesses. And remember, net exports as a percent of Chinese GDP is de minimis. It's only 5% of the economy. Everything there is focused on fixed investment, building and construction, and people have to keep their eye on that. That's the elephant in the room.
All right. We're here talking with Jim Chanos. So I teased that we were going to talk about the Buffett rule. What do you think about it?
Well, look, I mean, right now, the U.S. economy, I indicated before, spends 25% of GDP on government expenditures. It only is taking in 15 or 16%. Taxes as a percent of the economy are extremely low, as shocking as it is for people to hear.
Doesn't feel that way always.
It doesn't. No, I know it doesn't feel that way. But keep in mind, marginal tax rates were much, much higher in the past. And by the past, I don't mean the last 10 years. And yet the economy grew just fine. I don't know. It's just something. The discourse level in our country has really gotten to a point where you have to wonder, where we're demonizing teachers and firefighters and policemen, so that the highest wage earners can continue to earn, very, very, very large amounts of money and pay very, very low marginal tax rates. I just think, when did this country become so mean-spirited? And so I guess I'm for the surcharge. I'm going to probably have to pay it.
But as you said, even marginal tax rates, it didn't slow the economy in the past, did it?
It hasn't. I mean, our top marginal tax rates were 90% in the 50s. It was one of the greatest growth decades in the U.S. The problem is we have to focus on the middle class. And too much of the discourse in this country is on the very highest and on the very lowest ends of the spectrum. Oh, we should make the low feel some pain. Well, I mean, my God, if you're a single mother, working 2 jobs to make ends meet, I'm pretty sure you're feeling the pain, even though you're not paying any federal income tax.
Fair enough.
And again, so I think that what we really need to do is get the middle class, where wages have stagnated for we now get some data for 15 years now. That's what we've got to get going. That's the engine of this country. And, I'm not going to work any less hard if my marginal tax rate is 39% or 35%. I'm still going to try to make profits, hire people. So this argument that the rich are the job creators and won't work as hard if their tax rate is just ridiculous.
Do you think, Jim, that hedge fund managers who are only paying 15% or people who are only paying taxes on income that comes from dividends or capital gains should have to pay the same rates as someone who earns his income in other ways, say teaching or as a cop or as a newscaster?
Yeah, I mean, carried interest is fee income. This is a personal viewpoint of mine. I'm a hedge fund manager. Most hedge funds, by the way, are not as affected by this as people think, because most hedge fund gains are short-term in nature. And so the recalculation of that capital allocation still ends up hitting you pretty hard at higher rates. Where this really hurts is the private equity business, private equity, real estate, oil and gas. And one of the things that I've said is that whatever you do, treat all partnerships the same, Matt. Don't begin to exclude venture capital or exclude oil and gas. That's number one. Number two, if I ran a partnership and I run a managed account side by side, and I make 30% for those funds and get 20% of the profits, it's insane to say that in the managed account, where I would get paid out in January of the following year, that's ordinary income, but the same performance fee allocated within the partnership during that year is preferential capital gains. They're exactly the same thing, and I think that people are missing that. It's income, it's a fee. It's not a reallocation of capital.
Jim, I don't want you to go without us talking about health care, because you've talked about how it's that's our big problem.
It is.
In terms of Washington.
It is.
And we're not getting any kind of fix.
No. I mean, the health care reform bill was a golden opportunity. I think it was squandered last year in an attempt to get bipartisan support. It got watered down. It got universal coverage, which is great. But we covered our shorts by and large when we saw the bill, because we felt it was going to actually be positive for most of the healthcare providers, and those stocks have done well.
Right.
I'm beginning to rethink that position, and we're re-examining the healthcare again, because I think even on a bipartisan basis, people are beginning to realize you cannot address our budget deficit problem without addressing healthcare. We continue to pay twice what the rest of the world does.
So when you say you're rethinking your position, you mean your investment position in healthcare?
We're looking to add to our shorts going forward. Yeah, going into next year. I think there's no way you can do meaningful deficit reduction. No way.
Right.
Unless you begin to address runaway healthcare costs. And healthcare companies, basically in the U.S., get over half of their revenues from the United States government and state governments, and yet they have profit margins twice that of the S&P 500.
Yeah, they've done.
They grow faster, and sooner or later, we are going to have to address that fact.
One last question I want to ask you, because there's a company that's in the news today, Netflix, getting hurt again. You're short Netflix.
Well, yeah, but I still don't think we're profitable.
You're not.
Probably not.
But what do you expect? How do you expect this to play out? Coinstar too, right?
Well, we're short both. And the observation I would make is that Coinstar, which operates the red box kiosks, has held up just fine. But yet, all of this started with Netflix, with Reed Hastings realizing, I think correctly, that the DVD business is dying. And yet that's 80% of Coinstar's revenues, roughly, are DVD and
Okay.
about 2/3 of their cash flow.
We got to run. Jim, thank you.
My pleasure.
Jim Chanos, Kynikos Associates.